Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day, so let's get to the three market catalysts we're watching this hour. First up, President Trump taps Kevin Warsh to lead the Fed. We'll break down the market implications and hurdles the potential Fed chair does face. Plus, Apple sees record-breaking iPhone sales. We'll have full coverage of those earnings ahead. And we'll break down results from energy giants Exxon and Chevron and bring you the outlook for the industrials this year as well. Taking a look at the major averages right now, we do see them under pressure. Right now, the Dow's down about 190, almost 190 points. That's about a 0.4%. The S&P 500 down about the same amount, and the Nasdaq Composite down 0.5%. We got to look at some of the other assets today because between Kevin Warsh and some of the wild movements we've been seeing in the metals, there's a lot going on. As for rates and the reaction that we are seeing to Warsh, which we're going to dig more into in a moment, right now the 10-year yield up just about 2 basis points. So not a huge move upward here. Historically, Kevin Warsh has been seen as a hawk. In other words, someone who is in favor of raising rates. But as we talked about earlier this morning, there is among some the view that he's going to do what needs to be done, or he is a pragmatist in the words of one of our guests. And so perhaps he's not going to be as hawkish as he was in the past. The dollar as well bouncing a little bit after seeing a lot of recent volatility, and then taking that and looking at what's going on in some of the commodities this morning. Oil prices trending a little bit higher, but we have seen just absolutely wild movements in gold and silver prices. Here's the intraday look at gold prices, but I want to look at the 5-day just to show you the wild swings that we have had. So oil coming and topping $5,500 an ounce, and then plunging back down to around 5,000 as we have seen some of the movements in the dollar, but also some of the positioning perhaps get squeezed out in gold. And then silver also has seen a wild ride, although its plunge has been larger. So this is something that's been getting a lot of attention here this morning because the rally has been so strong in the metals, and now this plunge is also quite notable. Quickly, just what we're seeing sector-wise in stocks here this morning with stocks under pressure. Materials actually the worst performing group as we see some of that rollover in some commodities. Real estate stocks under a little bit of pressure as we see those rates higher. And then looking on over the NASDAQ 100, got to check here. Apple has been bouncing around this morning in the wake of its earnings. At one point it was a little change. Now it's back down again. So we're going to keep an eye on that as that does develop. And we'll talk about Apple shares a little bit more in a few moments. But we have to start with Kevin Warsh, don't we? President Trump has tapped Kevin Warsh to lead the Federal Reserve, ending months of speculation over who would succeed Chair Jerome Powell. Warsh is a former Fed governor. He aligned himself with Trump last year by publicly calling for lower rates, despite being a longtime hawk. Joining us now, Ed Yardeni, Yardeni Research President, and of course, Warsh was also considered to be head of the Fed when Powell ultimately got the job, Ed.
Right.
So what do you think of this pick? What do you think the markets think of this pick? And what kind of Fed chair ultimately is Kevin Warsh going to be?
Well, he definitely has a great resume, without a doubt. He is a pragmatist, as you mentioned. He has had some experience of being a hawk. Now he seems to be a dove. But I think he's going to be flexible. I think it's actually kind of fascinating that we got a fairly solid citizen here as a nominee. It kind of makes you wonder whether we needed all the drama that came with it. Of course, it's not a sure thing that he's going to get through Congress, but I think he will, as long as the administration signals that they're going to back off on attacking Jerome Powell. Let him move on and let Warsh come in.
We'll see if that happens, Ed. I mean, listen, we certainly didn't need all the drama, but the guy in charge, he likes drama, Ed. So
he likes drama.
So I think that's what we can expect going forward. You know, I'm curious when you talk about Warsh's resume. I know that he has come under some criticism by some folks around his commentary around the great financial crisis, when he thought that the Fed should not be as stimulative necessarily with its balance sheet. Is there anything we can sort of say, draw any lessons we can look at from that time to now?
Well, I think most economists would agree that QE1 was a necessary injection of liquidity. The question about QE2, QE3 is very controversial. I agree with the position that we only needed that liquidity round, and the rest was not necessary. And zero interest rates were also an extreme abnormality back then. But that, we all learn from our jobs, learning by doing. I suspect he's had a lot of that.
Yes, fair, very fair point, Ed. Now, as you pointed out, we've heard some murmurings that Tom Tillis might try to hold up this nomination unless and until the criminal charges against Jay Powell are dropped.
Right.
Any market implications if this gets held up for a significant period?
Yeah, I don't think it's going to get held up because I think the administration is going to back off on attacking Powell. There's no benefits in doing that. Powell's only mistake was that he didn't bring the project manager and an engineer when questions were asked about the renovation of the Fed. He clearly was out of his depth, and he just should have said, "I really don't know anything about that. I'll send you a letter." Right. So they got him on a picayune charge, quite honestly, and I think this too shall pass. Look, the administration's takes a tough, dramatic stand, as we just agreed, and then they kind of back off. They've done that on Greenland. They seem to be doing that maybe in Minneapolis. It looks like we're going to get a avoided government shutdown, and now we know who the Fed chair is. So there's a lot of uncertainties that actually are behind us.
Yeah, thank goodness. I'm also curious if you think that this Warsh pick makes it more or less likely that Powell will stay on the committee, even if he is no longer chair.
Well, I'll quote the Fed Chair Powell. I have nothing for you on that. Who knows? If I was him, I'd say, enough's enough. Let's go fishing or play with the grandchildren.
Yeah, according to recent reports, that is his strong inclination, unless he feels like he has to stay.
He doesn't really.
Yeah, who could blame him, really, Ed? As for that confirmation hearing, when it does happen, what do you think the most important questions for Warsh are?
Well, I think Congress is going to dig deep into his loyalty to Trump. To what extent will he be independent of Trump? He should be completely independent of Trump, but clearly Trump has made it an issue. The problem for anybody who was going to be Fed chair is it's kind of the position got tainted by the politicization of the whole subject. So I think there's going to be a lot of questions on his independence. And does he agree that the Fed funds rate should be down to 1%? And I don't know how he's going to dance around that one, because that's what Trump's been saying he wants. And there's no way that other Fed voters agree with that.
Speaking of other Fed voters, Christopher Waller was out with a statement this morning explaining his dissent, which was quite interesting. Among other things, he said last year's data will be revised downward soon to likely show that there was virtually no growth in payroll employment in 2025, zero zip nada. And he said, let this sink in for a moment, zero job growth versus an average of almost 2 million for the 10 years prior to 2025. He says this does not remotely look like a healthy labor market. Do you agree, Ed?
Well, I think there's a lot of moving parts to explain what's going on here, and I'm not quite sure. I'm relatively sure that lowering interest rates isn't going to fix the labor market. There's issues with lots of kids coming out of school with student loans and with degrees that are very ambiguous about what their skills actually are. I think there's a huge mismatch between what the economy needs. So let's face it, we need a lot of plumbers and we need a lot of roofers and people in basic trades, and that's not what's coming out of college. So
what do you think we fix? How do we fix that? How do you fix that labor mismatch?
I think time will fix it. This is a major technological change that's going on in our economy right now, and it takes a while for people to kind of figure it out and reinvent themselves. I think we're seeing part of the fix in new business applications. They rose to 5 million, all-time record high of 5 million last year. I think a lot of people are saying, the heck with it. I'm not going to bother sending another round of 300 resumes. I'm just going to see if I can raise some money from the family or a bank or a credit card, and I'm going to start my own business.
And Ed, you talked about all of the sort of like lingering uncertainties that we had at the beginning of this year, some of which are now seeming to be resolved. I know that you're looking for gains in stocks this year.
Yeah.
Anything that's happened thus far that has shaken you from that conviction, including the earnings we've seen so far?
No, I think the earnings outlook is great. The analysts thought it would be up 8% year over year coming into the fourth quarter. I think the numbers are going to be more like 10 to 12%. We've had really 3 quarters in a row now where earnings have been a lot better. We're going to have record earnings in the fourth quarter. I think that's pretty much a layup. We had record earnings in the third quarter, and earnings are really what drives the economy in the sense that profitable companies expand. They increase their spending on capital. In the past, they used to increase their payrolls, and the initial unemployment claims data and the continuing claims data give me some hope here that just as we've all given up on job expansion, suddenly it'll occur again. Maybe all that's been going on here is companies froze hiring until they figured out what AI could and could not do, and they're going to conclude that it can't do everything.
Let's hope that that's the case, Ed. Thanks a lot. It's great to see you as always.
My pleasure, Julie.
Coming up next, we're going to dig further into those Apple earnings. Stay tuned. You're watching Market Catalyst. Apple's first quarter revenue soaring 16% as iPhone sales climb. The tech giant reporting an all-time record for iPhone revenue, up 23% year over year. Joining me now, Tom Forte, Maxim Group Managing Director and Senior Consumer Internet Analyst. Tom, it is great to see you. As we saw there up on the screen, those Apple shares are flagging a little bit because of some concerns around margins. You took the opportunity to actually upgrade the stock because you were really wowed by those numbers, right, and by the forecast. I'm curious how worried you are about the margin issue. Obviously not worried enough to not upgrade the stock.
Yeah. So when we look at the March quarter as a starting point, despite supply constraints and despite potential inflation as it pertains to memory, Apple guided to 13 to 16% revenue growth and a very healthy gross margin of 48 to 49%. Now, the company does not provide an outlook beyond the next quarter. So I do think that there is potential that the higher memory prices could affect Apple and could affect the margins. But I would say working in its favor is that Tim Cook is excellent at managing supply chain. And with the very surprisingly strong demand for the iPhone 17 lineup, there could be an opportunity to take price. So I'm a lot less concerned about the margin outlook for the second half of this year for those reasons.
Okay, Tom, I actually want to play what Tim Cook had to say about the memory chip pricing issue on the call. Let's play that.
Memory had a minimal impact on the Q1, so the December quarter gross margin. We do expect it to be a bit more of an impact to the Q2 gross margin. We do continue to see market pricing for memory increasing significantly. As always, we'll look at a range of options to deal with that.
So I guess the question is, what does that range of options include, Tom? And for example, do you think that that Apple's going to raise iPhone prices this year?
Yeah. So again, I think that the surprise, at least to me, was how strong the iPhone lineup has performed despite Apple really having a substandard AI solution. So I actually think that's very bullish coming out of the quarter. And because of the strength of the demand, I think it does have pricing power. The other potential advantage would be for memory prices to come down later this year. And then again, I think that the strength in managing the supply chain is why I'm less concerned than maybe the market is by the flattish performance of the stock, despite the blowout quarter and excellent outlook for the March quarter.
You and I have talked about the AI story or lack thereof with Apple before. And as we've talked about, our tech editor, Dan Halley, says he's not convinced that people are going to buy an iPhone because of the AI, just like they weren't buying it because of Siri, for example. I know you feel a little bit differently about that. Do you think that Apple is starting to make some more significant progress on that front?
So first off, I think that the strategic partnership with Google essentially de-risks AI for Apple as it relates to investors' concerns about it. Now, what's going to sound strange view here is that I think that being slow to have an AI product is actually working in Apple's favor, because I think you're seeing a lot of consumers recognize that there's, for example, a lot of hallucinations going on, and that some of the other companies that have AI products on the market today, those products aren't necessarily perfect, and in many cases are flawed. So I actually think that and again, I didn't think it would play out this way at all, but being slow to market with AI, actually I think it has worked in Apple's favor. But the good news is, and yes, I'm skeptical like Dan, that Siri is going to be materially better when enhanced with AI. But I do think that over time, I expect Apple to at least be at par with the market when it comes to consumer services related to AI.
Tom, kind of to your point about the delay, have we figured out what the killer app is in terms of AI usefulness on the phone?
So it seems like, so I also wonder, Julie, about the OpenAI ability to generate a profitable business from AI. So stepping back and just looking at AI at the industry level rather than Apple specific. So I think it's unclear. If you look at Meta platforms, they're clearly benefiting from using artificial intelligence to improve the relevancy of their advertising and improve their digital advertising effort. But that would be more of a commercial solution for AI than necessarily one as a consumer. There's a lot of usage as it relates to search, but I anecdotally feel that Gemini isn't necessarily materially better than what I see from the legacy search results from Google and things of that nature. So yeah, I think, again, it's unclear to me what the killer consumer app is as it pertains to AI, and I think that's benefiting Apple in being slow to market.
And obviously we've seen yet more headlines on OpenAI. Amazon, for example, reportedly considering an investment in the company. As you think about that sort of ecosystem, if you will, Tom, are there other interesting investing opportunities at that point, especially since we've seen a little bit of a wavering in the AI investment enthusiasm so far this year, seemingly among investors?
Well, what I like, Julie, is I feel like investors are being thoughtful in saying, where's the return on the investment spend? And I want to get more comfortable that there is going to be a return on the investment spend, because the level of investment spending is just enormous. And then I guess the good news or bad news of having covered the internet since '96 is it reminds me of your company, so Yahoo, the early days of the internet, when it had a disproportionate amount of advertising revenue from startups. And I worry that Amazon, companies that I don't cover like Oracle and Microsoft, are over-dependent on OpenAI to the extent that this is still a startup, a very highly valued one, but again, they haven't figured out what their long-term business model is and if they could generate a profit. So I guess my concern for AI is that, we'll go with Amazon, that it may be over-dependent on some of these startups when it comes to either cloud computing revenue or things of that nature. So that's the risk that I'm trying to monitor.
And I guess Apple is not as levered to some of those things, interestingly. Tom, thank you so much. It's great to see you.
You too. Thank you.
Coming up, the outlook for industrials, the top analyst calls on Wall Street as well. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke DePalma. Let's turn now to some of today's top analyst calls on Wall Street. We're watching SanDisk, Southwest Airlines, and Spotify. First up, SanDisk. Raymond James upgraded the stock to outperform from market perform after quite a while. The stock analyst sees further upside for the stock, boosted by strong demand for its memory chips as the AI build-out ramps up, and what this could all mean for prices. There are now 16 buys, 8 holds, and 1 sell in the streets. Raymond James hopping on the train here. Next up, Southwest Airlines. BMO raised its rating on the stock to outperform from market perform. The analyst said it sees further runway in the coming years, including an eventual recovery in domestic main cabin market conditions and increased potential for corporate travel. The street is mostly on the sidelines with this one, with about 9 buys, 11 holds, and 6 sells. Last up, let's take a look at Spotify. Citi upgraded the stock to buy from neutral. Some reasons behind it are an attractive valuation and positive catalysts like more price hikes in the EU, potential price increases by digital service provider rivals, and accelerating buybacks. There are now 38 buys, 9 holds, and no sells on the street. So quite bullish on Spotify. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout the session.
Industrials are off to a strong start in 2026. The sector's up more than 6%. It's the third best performing group in the S&P 500. And joining me now is Steve Tusa, JP Morgan Managing Director and Senior Analyst for the electrical equipment multi-industry sector. Steve, great to have you here.
Thanks for having me.
So it has been a really interesting year so far, in the short year so far for industrials, because we've started to see some rotation, some broadening that everybody has been waiting for so long. What do you think have been some of the tailwinds that have gotten folks back interested in the industrials?
I think every year when the calendar turns, there's a bit more optimism around industrial production in the U.S., capital spending, this kind of U.S. onshoring theme that's been happening, I guess, or at least talked about for, it feels like over 10 years now. And every year that comes around, with the prior year being relatively sluggish, hope kind of springs eternal that we're going to inflect in the coming year. And that's been part of this rotation that's really been happening since last October, when there was a stark realization that the data center build out, which has been a huge driver of growth for my sector and industrials broadly, was happening. And all these results came in really strong on that front. Those stocks had a nice move. And the divergence between those growth stocks and your kind of run-of-the-mill industrial got too wide. And that reversion has been happening really for 3 months, but it's kind of carried into this year as well.
Yeah, and indeed, to your point, industrials were also the third best performing group for all of last year. They were up something like 18% as a group. So I guess that begs the question, will these hopes finally be realized this year? Will we see another year of that kind of outperformance broadly throughout the sector?
Just keep in mind, industrials is a broad universe. So
Sure.
I cover 20 stocks, and I would say there's 5 or 6 of them that have exposure to this data center theme. So that would be basically like our Mag 7, if you will. And those stocks continue to trade at a pretty significant premium and probably carried the majority of that outperformance last year. So make no mistake, the growth game in town remains AI, or as we call it in the industrial world, because it's a bit more tangible, data center build out. So that is the key driver. Outside of data center, I would call it a sluggish recovery, but a recovery. Things are getting better. Order trends are improving, but I think the term inflection is thrown around way too much. It's a recovery, but it's relatively sluggish. Look at CapEx budgets that have come out. Oil and gas obviously is a key part of the CapEx economy, and Chevron, Exxon today really kind of subdued CapEx for 2026. And the run-of-the-mill industrial player outside of maybe life sciences or semis is not really spending much more capital. There's still a lot of uncertainty out there, geopolitics, demand, most importantly. So I'd say recovering, but at a pretty moderate pace.
And so if that's the case, when you look at those data center exposed names, is it too late, do you think, for investors to get in because there's already been a big move in some of them?
No. I think that these stocks there's been a healthy skepticism around the term bubble, which I think has been written about now in many forms in the last 6 to 9 months. For the growth that you're getting in these stocks, they're actually trading at relatively attractive multiples. So I think in this build out, we're probably in inning 2 or 3, assuming AI development continues at pace. The data center build out of the pipelines we see is probably innings 2 or 3, not inning 6 or 7. So we're still, I'd say, not in pregame warmups, but earlier in the cycle, which means these companies are going to be growing and beating and raising probably for the next 2 to 3 years. And we're very comfortable that the valuations today on this recent pullback don't reflect all that upside in earnings.
Let's talk about, let's name names, shall we, Steve? Okay, let's talk about Vertiv, for example. So this is one that makes switches, so it's levered to this data center thing, but its valuation is a little bit higher, right? So, but I know it's also one of your top picks. So why are you thinking that valuation is worth it at this stage?
So typically, we're in a growth market, in my view. Earnings are still growing, so we're not in a kind of defensive mode. And typically, my group, run-of-the-mill kind of diversified industrials, trades at around a 2 times PE to growth rate. Basically, what that's doing is just discounting, the future earnings are more visible from a growth perspective, and they're a lot cheaper in kind of the out years. That's all kind of the PEG reflects. Vertiv, we believe, will be growing earnings 40% plus in 26, and probably another 30% in 2027. The stock's trading at about 30 times earnings, so that is less than a 1 times PEG. So for us, if you look at it on kind of an out year basis and where these backlogs are positioned and how the pipelines look, valuation is actually not a concern. And ultimately, with that kind of earnings growth, the bottom line is you don't really need multiple expansion. You're going to be getting 30, 40% earnings growth, at least this year, and then next year, still very attractive versus a group and I guess the S&P that's growing earnings at, a 10% rate and trades at 20 times. So I think these high valuations make a lot of sense in the context of the growth here. And honestly, a couple of them look relatively attractive for the growth that you're getting out there.
Let's talk about another of your picks, and that's Honeywell. Honeywell's had, a lot of swings over the past couple of years. Of course, it's remaking itself. It still is set to spin off its aerospace division. Is this one that also has sort of a data center peg? Are there, it's still sort of a diversified industrial. Are there other reasons that you like this one?
Different animal, idiosyncratic, some of the parts play. I know that's a lot of like Wall Street jargon, but basically it's meant to say it's a company specific play. They're breaking themselves up. And when you break yourself up, you become an asset value play. And the majority of their EBITDA and value is in aerospace. Right now, aerospace is probably the second best market behind data center. Very visible growth probably for the next 5 to 6 years. Decent amount of defense exposure here. We know how dangerous this world is and how those budgets are going up. And so Honeywell at a 15 times EBITDA multiple with 50% of their EBITDA in aerospace, which is trading at a 22 EBITDA multiple, suggests that you're getting the RemainCo assets, which are pretty solid industrial assets, for a pretty significant discount to my group. If you mark that to market today, we get to around 200 and about $80 a share. That's a pretty steep discount to the sum of the parts, and they're going to be breaking up in June. So you can kind of buy that RemainCo for very cheap today in the consolidated Honeywell. So a little bit different than the data center growth side. They don't really have that to a degree, but aerospace is kind of second best and definitely not reflected in their multiple.
I always like a self-aware jargon call out there, Steve. Appreciate that. And then just quickly want to touch on Johnson Controls, because here, this is also not one I think of as a data center play. So why is this on your top picks list?
I'm kind of realizing this, but they're on different parts of the barbell, and JCI is right in the middle.
Gotcha.
So JCI makes HVAC, heating, ventilation, air conditioning, as well as fire and security equipment for buildings. And some of those buildings, they're a leader in data center cooling. It's about 15% of their sales. So that is driving a lot of growth. Orders are strong. They have visibility to above average revenue growth, not quite like Vertiv. Vertiv's growing revenues 20 to 25%. These guys probably grow mid to high single digits. But this is a company that was put together through acquisitions over a 20-year period, some portfolio moves that didn't quite work out, and they weren't quite integrated and operated well. They have a new CEO that came from Danaher, which has a tremendous legacy of operations, and he has visibility to substantial margin opportunity that we would call idiosyncratic margin opportunity. So unlike Honeywell, where there's kind of a sum of the parts play here that's idiosyncratic, this one is much more about taking that above average growth and then driving much more margin expansion that leads to a comfortably above average 20% plus EPS growth. And it's trading in the mid 20s. So a peg that is comfortably below 2. So somewhere in between the two, idiosyncratic margin and data center exposure. But very attractive from that perspective. Also a bit of a defensive business model, so we don't have to worry when things roll over. This is not a bad place to be.
Steve, great to catch up with you. Thanks so much.
Yeah, thanks for having me.
Coming up, Chili's is capitalizing on consumers seeking value. We'll hear from the CEO of the restaurant chain's parent company about the growth next on Market Catalysts. Chili's parent company Brinker is extending its strong turnaround in the casual dining space. I spoke to CEO Kevin Hochman to break down the company's second quarter earnings report.
It's a lot of it is the same old things that we've been doing. We've been laser focused on the fundamentals of casual dining, improving food service and atmosphere. And that's exactly what we're doing every quarter. So, this quarter we had several food upgrades. We did more simplification in the restaurants. More of the investments continue to kick in. We had record food grade scores, record guest metrics going in. And that continued throughout the entire quarter. And then we wake up and we do a +9 on top of a +31 the prior year in the quarter for a 2-year cumulative stack of 43. Things are going really well at Chili's, and I don't think that's going to stop.
Well, and that's sort of my next question is that 31 to 9 is a slowdown, but 9 is obviously still really good, especially in this environment. That slowdown, is that sort of is 9 sort of the natural resting rate, if you will, or do you expect a little bit more of a deceleration just because you have grown by so much in Chili's for so long?
Yeah, the way to think about it is, we had many quarters of double-digit growth, and so the whole big debate about our stock and our company was, are we going to be able to roll the +31s with positive traffic, positive sales? Because that's the real test of whether that was a blip or this is a sustainable turnaround. And the reality is, +9 is probably at the very top of most comp store sales in the restaurant industry. To do that on top of an additional blowout quarter, just makes it incredible results that the industry has never seen. Several of the analysts, several of the folks that cover the industry and restaurants are saying this is the best turnaround of all time, not because of the numbers, but because it's so sustainable. 19 consecutive quarters of same-store sales growth and a ton of traffic growth as a part of that driver. That's why it's sustainable.
I mean, are the comparisons going to get tougher at some point, or are you guys sort of mapping that out and managing expectations around that?
Well, the comparisons are tougher right now, right? So the peak of our turnaround right now has been 2 consecutive quarters of +31%. So that happened of Q2 last year and Q3 of last year. We have now successfully hurdled the first hurdle of +31 with a +9, and then we're in the second quarter or Q3 where we had another +31 last year that we're very much on track. We talked about this in our earnings call. We were doing mid single-digit same-store sales growth heading into the storm. The storm obviously stopped that for a few days, but we are very confident we'll get right back to that. And we talked about having positive traffic in February, positive traffic in March, and we expect positive traffic in Q4 to have another blowout year.
Kevin, you talked about the fastest growing customer category is households earning under $60,000. We know those households are challenged in many cases right now. So how are you thinking about that? Are you really, do you have to be creative to keep those people coming through the door? Is that going to create margin pressure for you guys if you're offering, a lot more promotions, for example?
Well, we've been winning with all guests, including the low income, for a long time now. It's been behind our $10.99 3 for Me combo meal. And basically you get almost a half-pound burger, fries, unlimited chips and salsa, and bottomless drink, all for $10.99. And when you compare that to what you can get, at a fast food joint, It's very competitive from a price standpoint. Sometimes it's actually under where you could get in a fast food joint. Certainly the abundance is considerably bigger than most of the meals that are out there. So, we feel like we have superior value. But on top of that is when you actually come to the restaurant, you get an amazing service and hospitality experience, and you're doing it in a fun atmosphere. And I think that's the key. It's not just the price point. We're not the lowest price point out there, but in terms of the total experience and what you get versus what you pay, I don't think there's anybody that can beat us, and that's why we continue to lead the industry in growth.
And I know in the call, a lot of people, you talked about that $10.99 price point and that you have a lot of items available at that price point. How sort of committed are you to that price point? Are you going to have to raise prices on some of those $10.99 items this year if we see, for example, commodity prices continue to go up?
Yeah, we have what's called a barbell strategy. So we have obviously a very varied menu in casual dining versus like a QSR. So the actual $10.99, the mix of $10.99 is quite low. So it's about 9% of tickets, less than 5% of sales, right? So we have a lot of different options within the 3 for Me value lineup as well as outside of that. So no matter where you shop the menu, you're going to get great value. So like, for example, take margaritas. If you only want to spend $6 for a premium margarita, we have our Marga of the month. This month, it's the $6 resolution breaker. But if you want something a little bit more premium, you can get our Casamigos or our Don Julio, and that's going to be, closer to $10 to $15, right? And the reality is different guests have different needs. So that guest that only wants that hot price point, there are things for them. But the reality is most people actually buy other things on the menu.
Kevin, Chili's, as I said, has been doing great. Maggiano's, not so much. So how do you apply that Chili's playbook to Maggiano's, and how quickly do you expect to see better results there?
Well, it's exactly the same playbook. We got to get back to great food, great hospitality, and great atmosphere. And a lot of the same challenges we have at Maggiano's that we had when I started at Chili's. We've got to make sure the menu's nice and tight, and we're doing things scratch made, and they're incredibly abundant so that the guest sees that value. We were able to increase portion sizes of pasta by 20%. This quarter, we saw value scores actually start to creep up as soon as we did that. So we feel very good about that. From a service standpoint, we got to get more efficient and quicker. People, they want to eat within an hour, hour and a half. If you go to a more polished casual like Maggiano's, and then we got to make sure we are upgrading the restaurants, both in terms of the repairs and maintenance on the restaurants that were deferred during COVID that we've now fixed on Chili's. We need to do the same thing on Maggiano's, and then we have to start to get into re-imaging. We've done about 5 or 10% of the estate of Maggiano's today. They look amazing, and it's going to be a more relevant brand going forward. On Chili's, it took about 7 quarters to really turn the traffic growth. So this is not a simple process. I wished it was just a magic bullet that these brands can take and turn them around. But you got to put the hard work in. We got to put the investments in. But I'm confident we're going to see a turnaround in that brand too.
I'm also curious if Maggiano's is a little bit the victim of some of the more prevailing forces. In other words, pro-protein, maybe not as much noodles, carbs, And so I'm curious across the portfolio how you guys are adjusting to that protein push, the GLP-1 effect included. Like, are we going beef noodles, Kevin? Is that where we're headed?
Yeah, I'm a firm believer that we have to focus on the things we're really great at. Like, these brands didn't become like legendary and iconic and be around for 4 or 5 decades, because they were chasing trends. They typically are things that they're known for. So like on Chili's, we talk about the 5 to drive. So things like triple dippers and fajitas and margaritas, that's what we're known for. And when you're craving those things, that's why you're going to come to Chili's. Likewise at Maggiano's, you're looking for those amazing, classic Italian-American favorites that you love, like chicken parm and fettuccine Alfredo and chicken piccata and baked ziti. And, you're not going to necessarily, run to those restaurants if you're looking, to change your dietary habits and be super high protein. There are restaurants that do a great job of that. But when you want to have amazing indulgent meals at great affordable prices, abundance that you can have seconds the next day, that's the types of things that people come to us for. That's what we got to lean into. That's obviously been working for our company the last 3 years, and that's how we're going to continue to have success with our brands.
All right, no pasta made of beef. Check, at least not for now, Kevin, which is fine with me. Great to see you. Thanks so much for being here.
Hey, thanks so much, Julie. Great to see you too.
Take care. Oil and gas giant Chevron and Exxon both reported earnings before the bell, with both delivering their narrowest profits since 2021 as lower oil prices weigh on those producers. Stuart Glickman, CFRA Research and Energy Equity Analyst and Deputy Research Director, is joining me now. Stuart, how, in your assessment, have these guys been coping amidst an environment of lower oil prices?
Oh, hi, Julie. Thanks for having me. So, yeah, it's been really difficult, right? With the pricing headwinds that they've been facing. Brent averaged about $64 a barrel this quarter. It was $75 a barrel in the year ago quarter. So that's an awful big percentage headwind to be facing. And what they've been doing is they've been trying to go after higher return, lower cost projects with better break evens. And they've been trying to pull structural costs out of the system so that this is something that if oil prices remain kind of mediocre for a while, they'll be in better position to be sustainable. So they made some headway on that front, but certainly earnings power degraded. Everyone expected that, but they still posted numbers that were a little better than expected.
And on that front as well, of course, they've been spending. And it's not apples to apples when we're talking about Exxon and Chevron, so I guess we should talk about them individually. But in terms of their spending plans, are you convinced of the return on that investment at this point for each of them?
Yeah, it's a fair question. So a couple of things on that front. Number one, both of these firms are planning not for 26, not for 27. They are making their CapEx plans based around, what does the world look like in 2035, 2040? They're looking down the road because I think they have a view, and I think this is a correct view, that oil demand is not peaking anytime soon. A lot of the folks who, 10, 15 years ago talked about looming peak demand have had to move back the goalposts on that because that proved to be not the case. So there is an argument for needing to prepare for future supply. And some of these projects are multi-year projects to get to first oil and then to deliver, fairly low decline production growth in coming decades after that. So I think it makes sense that they have to have somewhat aggressive production plans, but you can scale that by figuring out where you want to attack, right? So and Exxon has talked about this, that they're so-called advantaged assets. The projects that have relatively lower break-even points, they made up, I think it was almost 60% of production in 2025, and that's likely to grow beyond 2030. So they're doing what they can, but if they were to pull in the reins and really slash CapEx, it might make for better numbers in 26 and 27, but it would leave them exposed in a decade to come.
And when you talk about how each of them is exposed and where they're leveraged, Venezuela is obviously a big sort of wild card. Chevron's already got the operations there. Exxon has indicated they are leery of being there. Is that going to be a big disadvantage for Exxon if they don't get involved in Venezuela, or is that sort of a blessing?
So honestly, I think it's a bit of a blessing. I would say two things about Venezuela. Number one, yes, Chevron does have kind of an early mover advantage if they choose to go back in because they already have the JV there. But all of these folks have long memories, and it wasn't that long ago that Exxon and Conoco and others had their assets expropriated. So that's the first thing. So you want to be first and foremost, you want to have more certainty about the political environment. And while Maduro is no longer in Venezuela, the rest of his regime is still there. So we are far from, approaching, I would say, political stability in the country. And there's a whole host of above ground problems that you have to solve before you can ever get to the below ground ones. Aside from the politics of it, there are issues around security. You're not going to want to bring your people into the country without assurance that they can go to work and not have their safety threatened by folks loyal to the regime. And then lastly, you still have to work out, some of the things that you and I take for granted, like reliable electricity. Venezuela is notorious for lots of brownouts and blackouts. So those kinds of things have to be resolved before you're ever going to move big dollars and big assets into the country. The second thing, and I think this is maybe a little bit misunderstood, yes, Chevron has assets in country, mostly in the Lake Maracaibo region, which is conventional oil, fairly low-hanging fruit. They could probably eke out some more gains there, but not, I wouldn't say game-changing.
Right.
Whereas the bulk of the estimated proved reserves in country are in the Orinoco Belt, which is heavy oil, tarry, very much like the oil sands in Western Canada. And developing those kinds of assets or resources is probably a decade plus and tens of billions of dollars. So I don't see any way that either company is going to go heavily into the Orinoco without resolving all of those above ground things that I mentioned a second ago.
Yeah, a lot of challenges there. Stuart, thank you so much. Appreciate it.
Thank you.
That is it for Market Catalyst. Have a great weekend.